What's up? What's up, everybody? Great to be back live with everybody. And after my travels last week and a couple of tapes, I'm here. I'm here live and in person. And I don't know. Markets are going to Pluto. I don't know. I know that's not a planet anymore, but the markets are going straight up. And for whatever reason, nobody knows. I mean, we know the economy's in such great shape. We know there's no inflation. We know that everything is great, and we're in great shape, and we should keep going higher, right? I mean, I don't get it, but who am I to tell you that the markets are the markets? And I think one thing you got to remember is that the markets are always right. Okay, that's the big key to remember. Whatever they're doing, the price action is correct. Okay, you can say it's wrong, but you'd be a fool because we're going right now, and right now they're heading up. Now we are still in consolidation. If you remember what we talked about with the different phases of the market, you're pushing through the upper end of consolidation, and more than likely, there's a good chance that this market will fail somewhere from around here. But certainly, while they're going straight up, I wouldn't be trying to figure out where they're going to fail from. The best thing you can do as a trader is to look at a shorter time frame. Okay, and when you see the failure come in, for example, if it looked here to be a potential seller, and I am not saying you should have sold there, but if you're looking there, that would have been a failure based on the red bar, the spike into resistance, and then the potential failure from here. Now, again, does that mean that we're going straight down? No, but you have to understand that the overall market phases will always play. Okay, and we can see now that we're working right at a resistance level, and if they do fail here, it would not be a surprise. But it's hard to say this is as far as it goes. So you have to have a trigger point as to when you're going to use that thing. You have to use trigger points in markets that give you an indication that your hypothesis or your solution is correct to what the markets are going to do next. Okay, so right now I have to wait, and again I'd have to go to a shorter time frame, which is basically what I do all the time anyways. And here are 4-minute charts that we're watching, and of course, thanks guys. I always forget to do that, but if you're watching, you can see there is that same consolidation pattern on a much smaller scale. So right now, if I was short from here, that would be fine. But I can see we're coming into some support levels here, and there's no surprise it would bounce. It would be no surprise if it bounced all the way back up to resistance. Now, by the end of the day, I would assume, and we can assume, that one of those sides are going to be broken. Either it's going to break to the downside or it's going to continue to break to the upside. But from here, and you can see this in all the major indices right now, that you have levels that we're sitting in a consolidation phase. Okay, and so what we'd be looking for is for which way to break. So now, if we're looking to make a play, okay, out of this pattern, you're waiting to see which way it breaks. Inside this range, there's no money to be made. Okay, you got to wait until it commits. Okay, and then you can take a position in either side. You can look at the notes as well. The 10-year notes are in consolidation. So we're seeing these like flagpole patterns or flag patterns, which are not giving us a real direction from here. And until the market commits in one direction or the other, we're not going to try to over anticipate the move. What we're going to try to do is we're going to try to wait for the market to tell us which way it wants to go. Because if you remember that what you're really looking at here is just one gigantic map or one gigantic footprint of markets. Okay. And by understanding how the phases of the market work, and you don't need a lot of indicators, you can certainly see the overall view of this market right in front of you. So as we look here, we can see that the S&P is potentially breaking out of this little consolidation pattern. We don't have an official breakout yet, so we're going to continue to wait. Okay, the Nasdaq is right up against resistance. The Russell is also at resistance, and the Dow is also at resistance. So right now, if I were looking to make, for example, an options trade and trying to take advantage of some premium, what do you think I might be doing here? Okay. And if you're listening, I didn't need my screen. I don't want to see my face. No, I'm just kidding. If you were going to make a trade here based on the information you have in front of you, what do you think would be the most logical next thing to make? Okay. And certainly I would say that, I would be looking to be a seller of call spreads here. Okay. If I were going to make any trade, and the reasoning behind that is because I am at resistance, I'm willing to take a limited risk, limited reward position. Okay. Oh, look who's here. Bear call spread. Very good. Yeah, we're just talking to you. I'm just emailing with you. So again, I'd be willing to take the chance that at worst it will churn around in this pattern. Okay. So if I'm selling a call spread, okay, and I'm going to bring up Thinkorswim, although I prefer Tradier, but it's easier for me to use this right now because it's here. But if I were going to look at this, so I could look at for September 1st and put up the SPY, which would be the equivalent of the ES. Okay. So if I was looking at September 1st and I wanted to sell a call spread, I would say, okay, so let's sell let's say the 447. Okay. 447, 448, or 440, any number you want, but here, 447, 448. So I'm getting 47 cents credit. My risk is $1. So basically I'm risking 53 cents. Okay. And I need for the next 3 days for the SPY to stay below 447. I'm protected up to 447.47 without any risk. And if it goes through here, then I am exposed, or I am at some risk. But at the end of the day, it doesn't matter, because again, I'm playing purely the mechanics of the market. I'm playing purely the phases of the market. Okay. And understanding that this should fail from here. And if it doesn't, well, guess what? I'll lose a little bit of money. But again, it's a trade that if you make it over and over again, it will more often be right than wrong. And I think that's something that you have to recognize, is that basically you're playing an overall probability model anyways. And in option trading, okay, it is about the probabilities. And I think you have to remember that the probabilities will eventually come out, and not the guys who sell that 90% probability, because you're not getting enough credit. Okay. The key to this business is not only making the right trade, but making sure you're getting enough credit, because there's going to be a certain number of times that you are wrong. So you have to make sure that the credit that you get each and every time you make a trade is going to be able to make up for the times that you're going to lose. And there's a simple formula to think about. If the markets spend 65% of the time in this consolidation phase, which they do, okay, if you're getting anything less than 40 cents credit, then now you're taking into the chance of potential losses if you do it right all the time. Versus if I'm getting 45 cents or 45%, then I'm basically locking in an overall long-term profit, okay? Knowing that I'm going to have losers and winners, but when it's all said and done, if I'm playing something that is 65% probability and getting 40% or 45%, that's 105 to 110%. So simply it means that I can lock in X amount of percentage by making the correct trade all the time and not giving up that big of an edge, okay, by taking less credit. Because again, in the trade I'm showing you here, okay, if I go 50-50, I'm going to be about even. Okay. If I go with the 90% probability, if I go 50-50, I'm going to be a big loser. Okay. So remember, the biggest thing about trading, the biggest thing about using options, okay, is to be at the highest amount of probability and keeping your risk down and making sure that you're collecting enough to make sure that the trade is worth it on top of everything else. And that's something that we have to remember at every point when we're making a trade, that it gives us the greatest opportunity. And it doesn't matter, where it is, as long as you're getting the highest mathematical probability, you're putting yourself in the best shape. Okay. And if we look, if we go through and look at a list of stocks, which these are the ones I follow anyways, but so if I'm looking at Apple, well, see, Apple looks like it's trying to break out of this consolidation range. So what would I be doing? Well, I'd be looking to see if I could find a short-term chart that might help me determine, again, the short-term chart is more up to you and what you're comfortable with. The shorter the time frame that you use to, as your what we call the decision-making trade or bar, the shorter you use, the more active you're going to be. And I would say to you that based on market conditions, I probably wouldn't want to be overly active today or tomorrow, or, I think that this is a really challenging week. This is one of the slowest weeks of the year. There's periods of time during the year, this being one of them. You've got Labor Day coming up on Monday, so it's going to be very quiet, which is allowing these markets to do more than they might be doing normally because many traders aren't around. A lot of people are on vacation. Okay, you've got a jobs number on Friday, but then the markets are closed. And I think back when we get to September, you'll see some more business. This also applies to the end of the year after the December expiration. Okay, you end up with a period that the markets are slow again because people are on vacation again for Christmas and so on and so forth. So recognizing the time you're in, okay, you can put yourself again in a better position. So right now, I would say that I'm choosing not to be overly active right now. I think right now is a time to be more passive. You can pick your spots and look. And of course, certainly on a short term, you can do whatever you want. But I think, there are times when it's easier to be involved and times when it's easier to be more passive and more on the sidelines. And I think that is something that you need to recognize if you're going to be active, okay? Because active trading needs active markets. I have no idea what you're talking about with that question. If you're talking about one of our current positions, I have no idea. Okay, but the right price is 1095. It is not a typo. It is 1095. Okay, it just happens that the stock has gotten away from it. Google. There, the stock's moved straight up. What do you want me to do? Okay, and I'm not changing it either. Okay, it'll sit at 1095 or I'll cancel the trade. But in the meantime, again, you have to remember your Google also starting to try to break out. Okay, and again, if we go down and look at our list, okay, Amazon came down, held support, and is now rallying a little bit. So what would be likely? Well, likely is Amazon should probably go back up to here. Okay, so that would be what we'd be looking for. We're looking for it to go back here. Okay, if I was looking at Bito, okay, look at Bito. Bito is a direct correspondent to Bitcoin, and this is something that we cover for people that may want to try getting involved in Bitcoin, but do not want to go involved with the wallet system. Okay, so this is a direct correlation, and this is starting to break out. Right, it was in consolidation, it's starting to break out. It's got a couple of gaps to fill. Okay, so where would I expect it to go? I would suspect that the first resistance would be right where it got to this morning. Okay, if we can get through there, then I suspect it'll get up to $15. Now again, is there any trade to be made? Probably not. Okay, but again, recognizing the pattern when the information shows is what you need to be prepared for. BitQ, okay, another one that is breaking out. Okay, now obviously we're seeing, this is another Bitcoin representative. This is a miner, okay, that we've traded for quite a while. In fact, we started trading it live on Monday nights at $3.47. Okay, and it got up to as high as $11.50. Again, what would I expect here? Well, if the rally continues, I would expect 760 or so to be support, and I would think it would try to make a run to 850. Okay, so again, this is what we're watching, and what you're really learning these different levels for and how to do them is why, so that you can put yourself in the best trading position when you're looking to put together trades. I think you have to remember the probability model that you are trading which is what trading is and what options are, is to put yourself mathematically in the best position, knowing that not every trade is going to be a winner. Who would be foolish enough to tell you that every trade is a winner? That would be idiotic, because we know that there are losers. And listen, I've traded. When I was in the floor trading, I traded. Some days I traded over 100,000 contracts a day. Did I think every trade was going to be a winner? No. But again, you're playing a game that is really about your skill level and about the law of large numbers and making the correct trade over and over again, knowing that they're not always going to be a winning trade, but knowing that at least your risk and the risk tolerance you have is going to keep you in the game so that you can come back and play it again, right? This is, if you compare trading to games, which that's all it really is: poker, bridge, gin, and backgammon. Those are the four most mathematical games that do have an element of chance, right? Because listen, you can make the perfect trade and get a bad break. Okay, you can make a horrible trade and get lucky. Okay, but the point is, if you're always putting yourself in the highest probability trade, then the odds of success are going to be much greater than if you're flipping a coin 50-50. Okay, that is what our goal is, to be at the highest probability. And how do we get to the highest probability? Well, again, first of all, we analyze the map of the market, right? So coin's breaking out too. And in fact, last night, and I had no idea this was happening, but on Monday nights, I do a live call. Okay. And I said last night that, to me, although we're short coin in our portfolios, I think it probably looks like it wants to bounce a little bit. Now, again, did I think it was going to go up $11? No, I'm not going to tell you that. I'm telling you that I did think it was going to bounce. And I could see by the formation, because you were holding and struggling on support. So if you're struggling on support to go through it, what is the most likely move you're going to get next? Okay. If it can't break down through support, logically, what is the most acceptable move you would think would be coming next? Okay. And if you want to answer it, go ahead and answer it, because it's important to understand. I'll come back and answer it in a minute. Okay. But again, as we look, you can see, okay, and here, notice a line I drew in last night. That's what I thought we would do, and I didn't think. But when you go back to coin, okay, I thought that it would bounce, and that is the highest probability, is that it would bounce from there, not for any other reason than it had gone down fairly sharply. It had gotten into a consolidation pattern and popped. Okay, now where would it go from here? Well, again, I'm not so hepped up to be actively trading right now. But if I were, I would be looking at this trade as a possible blow-off trade. And what that means is that this continues to go higher and volume continues to accelerate, then there's more than a higher probability that it's going to go down, okay, from there, once it finishes here, okay? And it's interesting because, as I told you the last time I was live, which was a week ago Thursday, okay, I told you that Tesla was trading down in this level here, okay? And I said to you that the next time we get together, Tesla will be between 230 and 260. Oh, geez, that's at 250. How about that? And again, it's not that I'm a genius, that I knew that I could prognosticate that. What I could tell is that the speed in which it went down was a great indicator that would probably see some sort of a bounce. And then we'll see what goes on from there. And here we are, up at resistance. So what would I expect? Okay, NVIDIA, which had earnings last week, I told everybody that I would be a seller at 500. Now, it actually went to 520 in the pre-market, in the post-market on earnings. And again, what was I playing there? I was playing the expectation of movement, the probability model, okay? And of course, this week we're going to look at Lululemon, okay? Because this is one that has earnings on Thursday night, into Friday morning. And here we have a stock that has an expectation of movement of $31, almost $32, which is about 8%, 9%, okay? And that is $31 or $32 in either direction, okay? So what I'm going to do here, I am not doing anything until Friday morning. Okay. And if this stock goes higher or over $32 higher, so we trade over 400, if we trade over 410, let's say, at 410 or above, it will be an automatic short for me. At 340 or below, it will be an automatic buy for me off of that number only, and it'll be a very short-term trade of 1 week. Okay, and why would I make that statement, and how can I make that call now? Because I am playing outside the expectation of movement that is expected in this stock. Okay, this stock is telling us, based on the option pricing, that it's going to move $31.74. Okay, on the earnings announcement. It could be before, but trust me, they're pricing in the earnings right now. Okay, and the higher the volatility gets, the more likely it is to collapse. First of all, we know the volatility is going to get sucked out of it, number one. Number two, we know that the stock is, if it goes much further away from what is expected, there's a greater probability of a retracement back to the mean. Okay. And that's what we're playing. We're looking for that retracement, and we're going to sell. We're not going to buy a naked put or a naked call. We are going to sell either a deep in the money put spread or a deep in the money call spread. Okay. Why? Because what we're really doing is we're going to create a synthetic option that has less risk, okay, than buying the put or buying the call. And it gives us a big chance for a big win. The only edge that we give up when we do a deep in the money spread is we give up the potential for unlimited profit or unlimited on either direction. Okay. And just if you want to understand kind of what I'm saying here, okay, if we look at this September 8th, so let's say I just want to sell a deep in the money call spread. So let's see where we're at. So I'm going to just sell, we'll just sell this vertical. Oh, you got to put me back in. That's right. See, I always forget that. Sometimes you got to wonder about me. Okay. So here is a deep in the money spread. It's a $20 wide spread that I'm collecting $11.30 for. So how much is my max risk on this trade right now? Okay. The max risk would, of course, be $20 minus $11.30, which would give me a max risk of $8.70. Okay. Now, if I'm risking $8.70, okay, what would the 377.50 put cost me right now? Okay, if I go to cross, the 377.50 put is $18. So would you rather, it's $8.70, by the way. That's okay. That's why you're having trouble with your track record. If you look at the put is at $18.35. Okay. So my risk here is $18.35 instead of $8.70. Okay. I can still make $11 if the stock goes down. Now look at it from another mathematical standpoint. If I sell this spread and the stock goes down to 357, okay, I have made $11.22. Okay. If I buy this put, okay, at 1840 and the stock goes down to 357, how much money have I made? Or how much money have I lost? Okay. Think about that. The simple answer is this put has now, if it goes to 357, has an intrinsic value of $20. I paid 18 for it. So I'm going to make $2, which means I'm going to lose $16. So which is a better trade? Okay. Think about that. Which is a better trade to make? Should I risk 1,800 and get a big move and still not make money? Or should I risk 800 and still have the chance to make $11 under the same movement? Okay. Because for you to make as much as I'm going to make on the same trade, the stock would have to go down to 330 something. Think about it. Do the math in your head, or use a piece of paper and a pencil. Okay. It would take you, okay, for me to cover the 18, it's got to go down 18. It's got to go below the 359 just to get my options to be worth $18, which I paid for. So if we're going to make another 11, it's got to go down to 347 for me to make the same amount of money. So my trade at 357, I make the whole thing. On your trade, for basically the same trade, I got to go down to 347. So which is a better trade? Okay. And these are the things that you got to learn if you want to be successful in this business, is what is the best trade? How do I put on the best possible trade for me and for myself to make the most amount of money? Okay. That is something I'm going to let you think about, and I'll be right back in 30 seconds. All right, welcome back. So did you think about the trade? Did you think of what you're supposed to do? And again, this applies to many trades, okay? And it applies to many circumstances, because if you learn how to do the coordination of what options fit to where, okay, it allows you to see the differences, okay? And, these are not, life shattering. These are things that will help you save your money when you're wrong, make more money when you're right, and always keep you in the game, which is, again, we go to money management and how it works. And by the way, speaking of all this, if you want to get more of this, there's a subscribe button. Make sure you subscribe to this channel so that you're always updated and notified when we're on air, because there's some other great shows here as well. And just to remind you that brokerage commission is part of your liquidity, which is why Tradier is the best broker for this, because of course you pay them a flat fee for your monthly commissions, and it makes a hell of a lot more sense. So make sure that you use the right tools for yourself. You're trading equities. Tradier is the best equity broker there is, because they save you a fortune in commission. You trade futures. There's a lot of great futures brokers. I happen to use CTG, but again, it's part of your overall liquidity if you're trading the commissions and cost. So as we go back and look now, we can see. So we're watching it. We're looking at NVIDIA. Again, it doesn't matter. We can go down our board. GLD breaking out from consolidation. Another one that we thought would break out, and I did think it might break to the upside. But again, it's not. This is not a question of be right or wrong. This is a question of understanding the overall action that shows up. Okay, that's more what we're concerned about, is the action out of the patterns that we're watching. IWM, again, breaking out. Microsoft, still stuck, and again, in this little pocket, which means that Microsoft is not getting as solid of action as the others are getting. And there's probably a higher probability that this is going to break to the downside the next time it breaks. Okay, but one of the things we have to be very concerned about today and going for the next 3 days after today are the lack of volume, which means that this is a much harder market for you to navigate and trade, because when you get light volume, it takes away from your liquidity. When you have light volume, it takes away from your opportunity and puts you in a bigger percentage of risk. Okay, so what you want to remember is markets themselves will give you some clues, but if you don't take advantage of those clues, then you're really putting yourself in harm's way for no reason. Now, again, this rally, I don't know what it's about, and I don't think that the markets have suddenly become much stronger again. I don't think anything has changed in the economy. I think we're in a lot of trouble. I think you can see that banks are once again over leveraged, and the emergency lending rate, which is where the banks go to the Fed to borrow money, is at all-time record highs. But again, that doesn't mean that we're going to run out and get short the market here either. We have to remember to let the market dictate to us what is the next trade to make. Okay. And sometimes there is no trade to make. Sometimes it's better for you and for everybody to sit tight and let the markets trade. And I'm going to say that right now is probably one of those times to let the markets kind of dictate that there's not much going on. So do I really want to get involved in today's market right now under the current circumstances when I know that volumes are minuscule compared to where they should be? Okay. I mean, look at what's going on here. Is this worth getting involved? Because again, where is your advantage? Okay. Our advantage comes from liquidity and movement. Now, short-term trading and long-term trading are not the same thing. Okay. If you're putting on positions and you're using the slow short time to make benefit for yourself, okay. If you're taking, like for example, I do a lot of calendars and double diagonals, okay, which means I'm taking advantage of selling either the daily or the weekly premium, okay. Those trades I can put in all day long because those I'm protected, and mathematically, I'm going to collect enough premium to make a profit on that trade virtually no matter what, okay. Now, again, if they go way against me, I'll have to make some adjustments, but overall, the simple math of how much you're going to collect versus how much you're paying is what you're watching. Okay. So in a slow market, I can benefit. Now I can also then adjust later if the markets look like they're starting to get busy. But my first objective always is if I'm doing a spread, like a calendar spread, selling short-term options, buying long-term options, I want to make sure that there's enough collection based on current circumstances that I'm going to collect enough to pay for these options out here. Once these options out here get paid for and there is no longer any risk, I can make up my mind how I want to trade from there. Do I want to take in more credit? Do I want to leg one side and see if I can get a home run to one side and cover up the other side? And again, that becomes the difference in the derivatives market is you get to make choices, but your first goal or your first objective on any trade is to get that trade to no risk profit. Okay. Now you won't always get the profit, but if you can get to no risk, it then opens up for you to have a lot of flexibility on what you're going to do next. Okay. So right now we're working on, and I've got a number of trades on in Tradier. Okay. With a number of double diagonals and a number of calendars. Okay. And I'll just kind of show you this here. Here are some of my positions. Okay. And you can see, that I've got a whole list of things here, and these are all based on buying and selling. You can see trades I've made today. Like I rolled my IWM diagonal. Okay. I rolled the shorts for a credit of 53 cents on a 10 lot. So I collected $530, and I've collected that or more every day or every other day for the last couple of weeks. So I already have paid for the trade, and it's how do I want to deal with the trade from here? And you can see that there are many things that we can do, okay, with these trades, okay, to put ourselves once again in the best potential position of success. Okay, again, it's an art. The spread is better because there's more potential for profit in exchange. Yes, you're the only thing you're giving up when you do a spread like I showed you is you're giving up the potential for unlimited profit. Okay, we know anytime we sell a spread or buy a spread, we know that there's a limited amount of risk and a limited amount of profit. Okay, but when we're playing like an earnings trade or a big move in a market, we are trying to put ourselves in position to give up on the time decay so we don't get killed on premium. Okay, and we don't suspect that the move is going to be outside where we would make that much, because I just showed you on the Lulu trade that I only needed a move of $18 lower. You needed a move of $30 lower to make the same amount of money. Okay. And your risk was 2.5 times what my risk was. Okay. And that is, again, these are all things that we constantly look at, we constantly try to combat against, is managing the over amount or the risk that we're taking. Because when we go back and we look again, looking at different charts, and again, I'm just putting these up at random, okay, but you are seeing, okay, so you have a Zoom, which is driving into some resistance, okay. Well, this is fairly bullish if it can break out. Now, we don't know that it can break out, but if it can break out from that level, okay, then we can we can assume that it's going to go higher. But we have to allow it to get there. We're not going to anticipate that. Why? Because we're sitting at a level of resistance right now. So there's no reason for me to try to guess that it's going to break out. I need to see it break out. I need proof that it's going to go through the next level. Okay. And as I look at, again, I pick up anything random here. Square. Okay. Square is just sitting in consolidation. It's in an overall downtrend. And of course, the speed in which it went down created too steep of a move down. So we would expect some mean reversion. Okay. We would expect the markets to revert back to the mean. Well, here we are. So if we look at this, and if I just flip over this to square to the Bollinger Bands, okay, which is it's a good mathematical indicator. I don't use it as a rule, but as you can see, okay, we got oversold, which made sense. You're now in consolidation, okay, and of course, if you understand the mathematics of this, as the stock has trended or stayed flat, the mean is dropping. So within the next day or so, depending on what happens today, we should reach and have a full retracement to the mean. So what would we expect next? Okay. Well, we would expect, based on the current trend, that would break to the downside. Okay. But still, we would use the phases of the market, and right now going up to consolidation, as a potential spot to say, well, let's see what happens here. But once it gives me a reason, and again, if I just go back to my shorter time frame here, let's use 5 minutes. Okay. So right now I have no reason to sell. I have no reason to buy because we're going nowhere. Okay. Now, had I been watching into this particular bar right here, okay, if I'd have been watching right into there, well, then maybe I would have sold it here. Okay. And again, I didn't do anything, and I'm not telling you that you should have, but that would have been a trigger point for me to sell if I were looking to get to the short side of that market. That would be what I would be looking at. Okay. And again, this isn't going to be easy. You're not going to learn it all on one day or in one session here. Okay. But, again, just flipping back to Tesla. Now, Tesla may be getting itself into what we call a blow-off formation. Okay. But we need more volume. If Tesla keeps going higher and the volume gets up to here, okay, then I will take a short position in Tesla. But right now it is lacking the volume. And what is the price movement parabolic in one direction or the other when it's included with volume? What does that tell you? Okay. I don't want to do that. I want to do this. It tells you that there's a lot of emotion to that trade. It tells you that a lot of people are participating and chasing it either up or down. In this case, it would be up is what we're looking for. It tells you that when they're done, it more than likely, high probability, is that it will fail and come back down and retrench back to the mean or retrace back to the mean. Okay. That's a question for Saturday. Or no, this is not a question for today. I cannot confuse issues with everything else I'm doing here. Okay. This is a completely different setup here. Okay. So I'm sorry, but that would be a question for Saturday, not a question for now. Okay. I can only speak in wider parameters here. Okay. So I hope you understand, but I can't do anything for you today. Okay, that's not for this particular call. Okay. Anyways, so as we watch again, we're watching a market that is running away. Okay, so let it go, let it run, and pick your spots. Now again, I do warn you, okay, that these conditions right now, even though we're exploding up right now in the indexes, okay, and I'm not saying they're not going to go higher. I would never say that. What I'm saying to you is that there is still a lot of risk here by trying to chase it up. Because why? Because it's too thin. And all it would take to turn this market to the other side is a relatively mediocre order of some size. Okay. And, again, when you're looking at a market that might normally trade, let's say 1.8 million contracts, and at this moment has traded 700,000 contracts in the busiest part of the day, might tell you that it's pretty thin. And again, what you have to remember about thin markets is they're not to your advantage. Thin markets are challenging because, again, there's too high of a likelihood that they can spin the other way and take you out before you have a chance to make money. And again, this is a game that takes an enormous amount of discipline. There ain't no free lunch out there. Nobody's giving you anything for nothing. Remember, you are in a competition. We're all in competition with each other, as a matter of fact. Now, we're friendly competitors. However, you are still in competition. And nobody's giving away ice in the wintertime here. They're gonna try to get the best fill, the best trade that they can get. And until you recognize that you are in a competitive field, because on the trading floor, if you couldn't be first, you didn't get the order. Okay. So, if you want to get the edge, you had to be first. Now, in this stuff, nobody gets the edge here except for the market makers. We're just trying to put on the best position to give us the greatest probability of success, because that's all we can do as a retail trader. Floor traders have a significant advantage because they're taking big amounts of risk to make markets. Okay, we're not making markets; we're making trades. We're making a decision on what trades that we want to make. Okay, so as we make trades, okay, we put ourselves in that position to give us the best possibility of a trade. And again, right now, I don't see a lot because I'm very concerned about the lack of volume. And I can go down to my shorter time frames, okay, and show you that the volume has been declining all day long. Okay. So where, as Clara Peller used to say, where's the beef? Where's the action? So in this kind of action, what are my expectations? Well, it can't be expectations of big profits and big possibility because there isn't enough movement. Okay. You're seeing the markets fall to basically going to sleep. Okay. So where am I going to get my best advantage? And right now, I would tell you my best advantage is going to come at my swimming pool as soon as I leave here, because trading in these conditions is extremely challenging. It's very tough, and it is not to your favor. Okay. This is when you have to recognize where the benefit to you as a trader comes in. And this is, again, could you make money? You sure can make money. But do you want to put yourself and expose yourself to more risk, thinking that you can overcome it, which I'm telling you that now, that more than likely you cannot overcome the amount of risk you're going to have to expose. Yeah, you can maybe do it today. Okay. I'm talking to you about the rolls, yes, but overall, I'm not telling that today is going to be bad and you're not going to make money. I'm saying that you have to create good habits to be a good trader. Okay. And every time you make an exception that is away from the rules that you have set for yourself is every time that you put yourself in danger. Okay. And that's why you have to start out with a solid trading plan, which has goals attached to it. And the goals have to be realistic. They cannot be out of reality. Okay. Because if you do that to yourself, what you're really doing is you're shooting, you're gambling is what you're really doing. And trading is hard enough, let alone we don't have to be gamblers. You want to gamble? Go to the casino. Okay, this is a place, this is a business in which you want to make money. Okay, and to be a gambler here is the sure route to failure as a trader. Okay, so I put you in warning and in positions, and I'm telling you that right now the trading conditions are not optimum because of the lack of volume. I would suspect the next solid day of trading might be during the jobs number on Friday. But after that, I wouldn't think it'll be much. I would suspect that every day this week it will get slower and we'll have a crescendo in volume Friday morning before the equities actually open. And volume will be all downhill from there because we don't expect much because it is a holiday. And of course, holiday trade is very slow. And you can bet that a lot of people are already on the road, and certainly those who are waiting will be on the road Friday. The minute that report comes out, after they set up their positions and set up their things, they'll be gone. So the question is do you want to fight into this basically dead market that has virtually no activity right now when you can get much higher probability setups? And that's something that you have to keep in mind. So as we get ready to call it a day, again, we would see right now the S&P is breaking through here. So the next resistance level is about 4,500. Okay. Now at 4,500, you might take a look at it and see how it reacts over that. And certainly if it starts to fail at 4,500, it wouldn't be a bad sale, but it's got to start to fail. You can't try to pick the top. It's like I wouldn't put an order in now to sell it at 4,500. I would want to see how it acted. So Friday's job number is a decent day for only trades or also for swings. Well, if you have something that you're trying to swing, it could be okay. But from a day trading or a short-term trading aspect, Friday morning, in fact, I'm going to trade it live with my members, but Friday morning at 8:30 Eastern, we get about 12 minutes to make some money. Okay. And that's over. But I mean, I would not be looking to put on a lot of positions right now unless I had a price in mind on something that I was working, that I was happy to buy and happy to own. Okay. Does that make sense? Again, I don't want to confuse short-term trading with longer-term trading and spot trading versus consistent trading. But right now, in the overall market conditions, there's not much to do. And that is really more the story. Okay. So for the rest of the week, I would be very, very careful. Again, it doesn't mean you can't trade, but don't be one of those guys or girls that sees a mirage in the market that doesn't exist and you force yourself into a trade that doesn't exist because you're sitting there looking at it. Sometimes you're better off turning off the machine, going away, and coming back later and reevaluating what's going on. Remember, the markets are going to be here 241 days a year. Okay, you have plenty of time to trade. There's no reason that you have to force it when the conditions are not the best for you. And for me, Todd Bubba Horwitz, that'll do for today. Make sure you subscribe below, okay, to the channel. You get notifications. You'll know when we're on. And I will see you all back here on Thursday. And thanks to my staff, my guys who take care of me and make sure I do the right thing, Reuben and Max. Thanks, guys. And I'll see you guys all back here on Thursday morning at what time? 11 Eastern, I guess, is my time. Adios.